In this video, I'll run through my 4 favourite ETFs that can be found on the Trading 212 platform. I'll discuss what companies the ETF are made up of, provide information on the yearly cost to hold the ETF, and what the distribution history looks like for each ETF. So first of all, let's remind ourselves, what is an ETF? An exchange-traded fund is a basket of securities that trade on an exchange, just like a stock. So instead of buying a share in one company, you're buying a share in a wide range of companies. There is typically a charge associated with owning an ETF through the form of a management fee. These are usually pretty low at around 0.1%. So if you held £10,000 worth of ETFs with a management fee of 0.1%, you'd pay £10 per year. You'd also hope that the capital gain or distributions would cover this fee over the year. I use Trading 212 as my brokerage, and not all ETFs that exist in the market are available, but they do have quite a wide range currently. I'm invested into 4 ETFs on Trading 212, and I'll talk you through each one of them now. The first one is VUSA, which is the Vanguard S&P 500 ETF. This is a stock market index that tracks the performance of the largest 500 companies listed on the US stock exchange. There are actually 505 stocks in the fund as of the 31st of December 2020, and the top 10 holdings are made up of some real global powerhouses: Apple, Microsoft, Amazon, Facebook, Google, Warren Buffett's Berkshire Hathaway, Johnson & Johnson, JP Morgan, and Visa. It's currently trading at £53.69 per unit and has an ongoing charge of 0.07%. The current distribution yield is 1.36%, and this is paid quarterly. The distribution yield applies only to mutual funds and ETFs. It's the ratio of all the distributions of a fund over the last 12 months, divided by the current share price of the fund. There is a difference between the distribution yield and the dividend yield. The dividend yield will show you the percentage of the share price an investor received as dividends, whereas the distribution yield consists of 2 components, dividends and capital gains, which are then paid to the holder. It is basically the same thing, i.e. a form of cash flow, which is what I base my investment approach around. So if we have a look at the quarterly distribution history over the last 5 years, we can see a definite increase over the period. One thing to note about ETF distributions is that they are quite erratic and tend to jump up and down a lot. This is because the payments are all coming from a large number of companies, rather than just one. So some companies within the fund will have big dividend increases, some will cut their dividends altogether, and some will remain steady. So the ETF payouts are an amalgamation of each individual company's actions. Historically, the returns from the S&P 500 have been very, very good. America is a global economic powerhouse, with many US shares performing extremely well over the years. Because the S&P 500 tracks some of the best companies in the US, investors have reaped the rewards. If this upward trend continues, what I hope to see is that I build an attractive yield on cost. Yield on cost is the current distribution payout divided by the cost paid for the shares. For example, if I purchase today at £53.69 and the current payout is 73p per year, this is a yield of 1.36%. In a few years' time, the payout might grow to £1.20 per year, so my yield on cost would increase to 2.23%. My second ETF is ticker VUC. This is the Vanguard FTSE 100 ETF, which is a stock market index that tracks the largest 100 companies listed on the UK's London Stock Exchange. There are actually 102 stocks in the fund as of the 31st of December 2020. The top 10 holdings are made up of Unilever, AstraZeneca, HSBC, GlaxoSmithKline, Diageo, British American Tobacco, Rio Tinto, Royal Dutch Shell A, BP, and Royal Dutch Shell B. It's currently trading at £28.67 and has an ongoing charge of 0.09%. The distribution yield is a bit higher at 3.48%, and they are again paid quarterly. So if we have a look at the quarterly distribution history over the last 5 years, we can see a clear sideways trend, with a slight drop-off in 2020. I do usually like to see upward trends when looking at dividend history, but we can also look at this sideways movement and say that at least it's a very consistent payment history. Again, as per most ETFs, we see the erratic nature, jumping between 20 pence per unit and 40 pence per unit. But the important thing to remember is that the distributions are stable, with no cuts, which is a risk you have when holding individual stocks. Compared to the upward trajectory of the S&P 500, the FTSE 100 is said to be trading sideways, so the capital appreciation might not be as good historically, but comparing the 3.48 distribution yield to VUSA's 1.36% distribution yield makes VUC appealing to me and other investors that are trying to create a source of cash flow. The third ETF I like is the Vanguard FTSE All World High Dividend Yield, ticker symbol VHYL. This index is comprised of large and mid-sized companies in developed and emerging markets that pay dividends that are generally higher than average. An emerging market economy is the economy of a developing nation that is becoming more engaged with global markets as it grows. Currently, some notable emerging market economies include India, Mexico, Russia, Pakistan, Saudi Arabia, China, and Brazil. There are 1,507 stocks in the fund as of the 31st of December 2020. It's currently trading at £42.25 and has an ongoing charge of 0.29%. If we look at the allocation of stocks per region, we can see that nearly half of the fund consists of stocks from North America, 24.3% in Europe, 16.5% in the Pacific, emerging markets take up 14.3%, the Middle East 0.1%, and the rest of the world at 0.4%. The distribution yield is 2.97%, and these are paid quarterly. So if we have a look at the quarterly distribution history over the last 5 years, similar to VUC, we can see that it tends to be trending sideways, with a slight drop-off in 2020. You could argue that there is a very slight upward trend in amongst the erratic nature of the ETF payouts. It makes sense for me to own this high dividend ETF alongside my UK and US ETFs, just to further diversify away any risk associated with any one particular economy or location. And the last ETF is the HDLG. This is the S&P 500 Low Volatility High Dividend, which measures the performance of the 50 least volatile high dividend yielding stocks in the S&P 500. It's currently trading at £21.84, with an ongoing charge of 0.3%, which is the highest of all the ETFs I've discussed. The top 10 holdings are Iron Mountain, Dow Incorporated, Huntington, International Paper, PPL Corp, Altria, CenturyLink, AT&T, Philip Morris, and Hanesbrands. It has a distribution yield of 4.34% and payments are quarterly. Looking at the dividend history again, we see a clear upward trend, which is always nice to see, and I hope this continues into the future. Again, just to reiterate my point with ETFs, we see the irregular dividend pattern. I like to own both VUSA and HDLG, as the distribution yield for VUSA isn't as high as VUC or VHYL. So, by owning HDLG alongside VUSA, I can achieve a combined yield of 2.85%. With HDLG having a lot fewer holdings than VUSA, it is a little riskier, but holding both together should offset some of this risk. I believe that ETFs are a great way to diversify out some of the risk associated with companies cutting their dividends. I like to hold these 4 ETFs as it gives me exposure to a massive array of companies and markets all over the world, which I hope will diversify out some of the risk in my portfolio of being too heavily exposed to one particular country or market. Now let's line up all 4 ETFs alongside each other to compare and contrast some of the numbers I've mentioned. By combining these 4 ETFs at an equal 25% ratio, it allows me to obtain a 3.04 dividend yield. Also, by combining the 4, I can average out the ongoing charge to 0.19%. As a UK investor, being able to purchase these ETFs in GBP means that I can invest in overseas companies but won't be exposed to any exchange rate fluctuation risks. For example, if you were to buy $2,000 worth of stock at an exchange rate of 1.32, I'd have paid £1,515.15. If the exchange rate moved to 1.4 and I tried to sell that $2,000, I'd only receive £1,428.57. On top of that, I also won't be subject to any withholding tax paid on distributions, as I would do through purchasing individual US companies. So this means that I'll receive the full distribution tax-free, provided they are held in a UK stocks and shares ISA. I have a lot of individual stocks in my portfolio currently, and I want to protect my dividend payouts by having at least 40% of the portfolio as ETFs. I currently have around 10% of my portfolio in ETFs, so over the next 5 years, I aim to keep investing regularly in these 4 ETFs to hit my target ratio. I hope that you've enjoyed this video and found it interesting and informative, and I hope it's given you inspiration and ideas for your own personal finances. If you have, then please like the video and subscribe to the channel, and let me know what you think in the comments section below. Thanks again for watching, I really do appreciate it, and I'll see you in the next video.